Welcome to the Dividend Talk podcast, episode 234, analyzing top earning reports of the week. It's been quite a busy week, European DJI. I've seen you've been very, very active on social media, posting all sorts of earnings. I mean, you you must be up really early reading all of these.
Well, yeah, I've got two kids and a wife and two dogs and a cat. So yeah, it's not too, it's normal for me. But yeah, lots of European earnings this last week. So for me, that's always like the highlight of the year because so many dividend announcements. I don't even look at the earnings then. I mostly take out the dividend announcements at that moment in time. So, but how it looks for me, I'm just, waking up at 6, naturally, kind of 6:30. The earnings come in 7:30, 8 o'clock, depending on the company. I've got my list ready. I check 3, 4 companies quickly for the dividend hikes, and then I just go to work. And then the evening, I go a little bit more through the earnings, also for the newsletter and such, to see if there's anything that raises awareness. But yeah, come on, these are the weeks that we are living for, as dividend growth investors, as podcast host, newsletter, you with your new YouTube career as well. So, I mean, these are the exciting weeks, really.
Yeah. But there's so much to keep up with. I know obviously follow you a lot, but also on Facebook, there's so many people chiming in with some of the earnings. It just makes my life so much easier. I have to say, I don't have to follow every single company I own. I can just wait. Somebody else will tell me how the company is down. So
what I like about the Facebook group is there are quite some companies I noticed in my blind spot, which are from Scandinavia.
Yes.
And we have a few good contributors that are always nicely sharing the ones in Scandinavia as well. So also, of course, triggers me to do a little bit more research there already. I'm getting already more familiar with the Swedish stocks. I own a few as well, like Cibus and Evolution. But I think there are still so many hidden gems out there that really respect the dividend growth culture in the end.
Yeah, particularly Finland, I find some strong candidates that comes up a lot, and even Norway. So
Yeah,
maybe there's an episode on Scandinavian stocks. I know we did Swedish before, but I think we do have to go.
Yeah, we just need a few good guests from Scandinavia. That would be nice.
That would be very nice, very nice. But anyway, let's talk some news of the week. And notice you have something here about Macron. They are investing around 109 billion, which is not a small sum, in AI in France.
Yeah, and that was very. I mean, the week before, right? We had this whole stuff in Europe going on, like, we need to invest in AI. We need to win the technology race. GD Vance, the new vice president, is in Europe, also making some noise about America first AI, and saying like something along the lines of like, okay, guys, we're going to create AI, and you better use it. You can try it on your own. We're not really going to tolerate that. And don't bully our companies. That's what it comes down to. Yeah, it's a wild west at the moment, AI, and as a content creator, I don't really like it because others are harvesting all the knowledge that we're sharing. They have a business model around it, and we don't get anything in return, not even a thank you. Yeah, so that's what I don't like about it, and that will have to settle itself at some point in time, because otherwise you will just get dump AI in many cases, or at least no new content created, because content creators will just block it from the crawlers and everything. But that aside, right? I'm happy to see that Europe is also starting to really think about some prioritization of AI, and I don't think they like to say yet like deregulate. I mean, they want to deregulate in some areas, but I don't think they're still a bit withholding, like, should it go at the cost of climate change or not? But they are talking more, we need to prioritize AI. So I guess that's what it comes down to in the end, because it requires a lot of energy. And in that line, let's say Macron also now unveiled plans, 109 billion of AI investment in France. And I think it's really good that they are doing this, that they're really taking it serious. I mean, the European in me finds it a little bit annoying that a lot of it comes from Brookfield, the investment firm from Canada, and also from the United Arab Emirates. And I find it a bit of pity that we don't see the big investors like the Norwegian State Fund or something like that, right? That has a lot of cash there. So that I still like find a little bit of a pity. Also, Van Leyen today was putting on Twitter about we need to heavily invest in our defense here and really, start scaling up our investments. I also hope they're really invested in European companies. We have some really good defense companies. So, what I really like is that the Eurocrats are starting to wake up a little bit to reality. I think many people in society have been saying this already for several years, and they're starting to wake up. But I all the time have this issue like, okay, but the ones that created the problem, are they really the right people also to solve the problem? I have a hard time. I have a really hard time thinking about that. But at least, Macron is doing something about it. 109 billion is a lot of money for France. I hope they spend it wisely, and it will have a lot of infrastructure focus. So it will be really focused on establishing data centers. But where do you put them? It must be North France. I mean, there's really South France is too pretty, let's say.
Yeah.
Put it anywhere else.
They'll come to Ireland. Ireland has the right climate. It's cool. It's not too hot. Plenty of green
but then
space.
they need to capture Ireland first.
Yeah, yes. But it's quite interesting, isn't it? Like, you look at what Trump has done since he has come in, and he's obviously giving Europe a kick in the backside because
wow. Yeah.
I think the US of A was our safety net for such a long time. And now he's saying, lads, you need to sort out your own defense budget. You need to look after your own technology. I'm taking all this away from you. So you have to kind of.
Well, if you have some time, yeah. 2 hours if you wanted. But I really love Ray Dalio in this context because I think 2-3 years ago, he's starting to write and to also share information about how great empires come to an end.
Yeah.
And it's typically that the empire starts to take on too much debt. This debt also starts to lead to civil unrest because, certain decisions are being made and the common man starts to be angry on the wealthy man. Yeah. And this usually leads to a war. It can be civil war, it can be international war, but usually it's because of the debt. And this is what I'm seeing, because what he says also, like, those empires can't fund wars anymore abroad. They don't have the money for it, and because they can't fund it anymore, they start to focus more inward, and with that, actually, the empire start to dismantle itself. That's what it comes down to in a nutshell. Yeah. And if you then know that from 2-3 years ago, Ray Dalio was all sharing with data behind it, how that went over the centuries. Oh my God, it feels like history is really repeating itself here. Yeah. So the good thing is, like, they are taking drastic action in America to do something about it. At least with this government efficiency office that they are doing. I don't know if that's really enough. But at least if you hear Elon Musk speaking this week about it, he uses these kinds of terms like, if we don't do anything about our debts, we're gone, kind of. Ray Dalio also this week, in 3 years, if we don't get the budget gap to 3%, it's 7.5% now, there's an issue. And, this is kind of my thinking about this. Like, all that we're seeing, I'm really hooked into this story of what Ray Dalio showed the world, let's say, about how empires come to an end, and it's just playing out in front of us of what he kind of described there.
Yeah, you can see it playing out in both America and Europe. You can see both of those signs playing out. So yeah, Ray Dalio is an interesting character, and I haven't read a whole lot. I've read the outline of some of it. I know.
Yeah. There's a really good video about it on YouTube. Google search for it on YouTube. I think it's half an hour or something like that.
Yeah,
it's really, really well explained. Really well.
Well, let's look at something a little bit more positive, and we'll talk about dividend hikes, and we have lots of them. Do you know what? This is probably the best quarter for earnings because we get lots and lots and
Yeah.
lots of dividend hikes. So we'll try and spin through some of these fast, and we might dwell on some of them a little bit longer. But Meta Platforms, aka Facebook, announced its first dividend hike, and it was 5%. This gives it a whopping dividend yield of 0.3%. I'm not sure if you still own Facebook or
No,
not.
I sold them at $500.
Yeah, they're gone. Nestle, which is probably the longest dividend aristocrat in Europe, has another dividend hike of 1.7%. But what we're seeing here is a continuing trend of lower and lower and lower dividend increases.
Yeah.
At some point, it's going to go to zero, isn't it?
Yeah, but I hear often saying people giving management kind of an excuse that, for instance, the Swiss franc devaluated over the last few years by 20%.
Yeah, which is true.
So there is something to say like that, but come on, management is still buying back shares. I just looked, I did a back on the napkin calculation, and they've been outspending cash flow again. Why the hell are they doing this? Why? I really don't understand it.
Because they're not growing organically, so they have to buy back
I
shares.
understand. But why leverage up the balance sheet?
I
know they own, I think, some percentage in L'Oreal and such. I understand that, but why?
Yeah,
it is not needed. Yeah, they had. I mean, they had. If they would have not bought back all the shares at a 30 or 40 PE, yeah, and just kept on increasing owners' equity, then they had a really clean balance sheet right now. And then now they could have kind of turned on the buyback machine, leveraged a little bit up. But this is such poor capital allocation. It really annoys me. It really annoys me because you've written a few times about it, also in the newsletter, about the debt. It's not bringing the company anywhere. It's really just like, and you see this a lot when companies are owned by management that is only there to self-enrich, and that's the feeling that I have here. They don't care about the balance sheet because in 5-6 years from now, they are not looking after this company anymore. At that time, they can sell all the shares after the shares are being released, and they can park their wealth elsewhere.
Feels a little bit like Bob Swan when he was with Intel. It feels that kind of way with management, and
yeah, it feels like that. Yeah, the only benefit to Nestlé is it's such a slow compounder that it will take 10 years or something like that for the company to really get into severe trouble. Because with Intel, they operate in the semiconductor.
Yeah, of course.
A winner takes all industry almost.
Yeah. Cisco hikes its dividend by 2.5%. I think that's about 14 years for Cisco. T. Rowe Price, which we both own, hikes its dividend by 2.4%. And this is the 39th straight year of dividends. And similar to Nestle, it has been slowing down over the last 3 or 4 years. We were getting used to these double-digit hikes, but they're still struggling with outflows.
Yeah, but T. Rowe still has a good balance sheet. That's the big difference.
Pristine, yeah.
They could turn the buyback machine on if they wanted to.
Unipol Gruppo hiked its dividend by 123%. This is a fabulous, and it was given to us by one of our members. It was on Twitter. A fabulous Italian insurance company. I don't know if you are aware of them or know them. Ahold Delhaize with a 6.4% dividend hike, which was quite nice. I think free cash flow. We'll talk about them later. About it. Relics Group hikes their dividend by 7% to 63 pence per share. Unilever announced a second dividend hike over the last 12 months. I'm actually pretty shocked with this. But a second dividend hike over the last 12 months. This time it's by 3%, which makes it year-over-year growth. Wait for it, 6.1%.
Wow. Yeah, they're back to the dividend growers club.
I mean, if I was a betting man, I would not have predicted that. Not really.
No, me neither.
British American Tobacco hikes its dividend by 2%. We'll speak about them later as well. Legrand hikes its dividend by 5.3% to €2.20 per share. Still have quite a few to get through. We'll roll through. Orkla, a Norwegian company, hikes its dividend by 33% and pays a special dividend of 6.
That's a kaboom.
That is a kaboom.
Yeah, and really out of historic trend. I mean, kudos to all the shareholders here. Amazing.
Deutsche Börse hikes dividend by 5.2% to €4 per share. And Euronext, it's quite a big raise by Euronext. It's 14%.
Yeah.
Quite surprised with that.
Yeah, and they're both, stock exchanges, right? Like London Stock Exchange Group, CME last week. So that seems to be a really good line of business to be invested in.
Yeah. CME Group had a decent hike as well. So Euronext looks like a good one to look at. I do like the London Stock Exchange because into this whole data and cloud business.
Exactly.
That's quite strong. You go on to Interactive Brokers, you go on to the Gyro.
Yeah.
Getting all their data from these guys.
Exactly.
So, Euronext is probably one I'd like to look into next. Where they'll have a
Wereldhave.
Of course, I was never going to say that right. It was a tongue twister. But it reported earnings and hiked its dividend by 4.2%. That's a company I've noticed you posted about them quite a bit. Heineken, and do you know what? I have to thank you guys when you went to Amsterdam, when you went to Utrecht.
Yeah, for the dividend day.
A couple of weeks ago. They hiked their dividend by 7.5%. So kudos to you guys. I know you drank a lot of Heineken that day.
Oh, yes, definitely. So we contributed to that to the earning. That's for sure. I mean, management is still wondering what happened in January to our sales. Like, was anything special happening? They were all asking each other, and then they zoomed into the data, and they found a pub in Utrecht that was contributing to a 30% increase of their sales in January.
And the Irishman wasn't even there. Imagine.
Exactly.
Mandatum, we spoke of Finnish companies earlier, but Mandatum are a really nice company. I looked at them a long time ago, but they hiked its dividend from 33% to 66. So nearly
another kaboom.
We keep going with Storebrand from Norway raised its dividend by 15%. DBS Bank has an 11% hike. Rockwool AS hiked its dividend by 29.4%.
Another kaboom. I mean, we should really have a sound or something like that for this. Kaboom. Yeah.
I'll have a look and see if I can edit one in. Restaurant Brands hiked its dividend by 6.9%. I missed this one, and I'm glad you've put it here, but Brookfield Asset Management hiked its dividend by 15%, which is quite strong. And NextEra Energy with a 10% hike.
What a dividend hikes. I mean, for me, sometimes you wonder, should we all read it up in the podcast? But this is what the whole podcast is about. We are dividend growth investors. Yes. And when I see this list, I mean, amazing. I own a few of these, and effectively most of my salary hike is already defined now for this year. There will still come the insurers soon, like NN Group, ASR, a few of those. But oh my God. And the Europeans have been on fire, some of those. Unbelievable.
Especially Scandinavian companies in Norway and Finland. It's crazy.
Where have they been hiding all those years?
But Brookfield Asset Management, for me, that's a 15% hike of one of my largest positions as well. I think it's number 6.
Oh man, you lucky bastard.
Quite a hike from my end. I mean, I'm going to have my yearly review maybe a couple of weeks time. I'm going to have to go into my boss and say, you need to match 15%. You need to match it at least. This is what I'm getting.
My other income stream is giving me this.
They might kick me out the door.
Imagine that you go to your boss and you come with a dividend check and you say like, "Hey, this was my salary hike there. You know, now it's your turn."
I just watch the face.
Exactly.
But yeah, plenty of dividend hikes and plenty more to come, I would say.
Yeah, nice. And congrats with the 15%. I mean, double-digit salary hikes are really, really helping a lot to the compounding.
Okay, so we are looking at some earnings this week, and a popular one. I'll start with British American Tobacco. It seems to be all over our Facebook page. El Cuba asked us about both British American Tobacco and Siemens. So I'll start with British American Tobacco. And I think why this has got so much attention is because over the last few weeks, we know that they have been on an absolute tear. Their share price has nearly gone up through the roof. And then they lost 10% of it in nearly one day. So why is the question? And when you look at the top line numbers, it's hard to figure out quite why. Revenue did drop slightly, which is to be expected. We know volumes are dropping in that sector. US had a difficult year. So that's kind of in line with expectations. Their operating expenses actually jumped, and I'll get to the reason why that is in a few minutes because it's quite important. But you can see there was a huge chunk of depreciation, amortization, and impairment costs, which was nearly 28 billion in 2023. It was only 3 billion in 2024. So that gave them profit before tax of nearly 3.5 billion. It was negative this time last year. So you can see by these numbers, it already looks a little bit better. They also hiked their dividend, as we said, by 2%. So the question is, why? Why did the share price drop when everything looks to be okay? And what I didn't mention there is new categories was up again by about 143 million, I think, up about 7%, which I find quite interesting because if you go back 2 years and last year, they say they want to hit 5 billion in 2025. They're sitting at around 3.5 billion at the moment. So they have no hope of hitting that 5 billion in 2025, but it's still nice to see that growing and profitable. Where it kind of fell down is one, there was weak guidance in 2025. So they didn't really say what that was. They've given guidance towards 2026, but they have mentioned that there is some regulatory kind of problems in Australia, Bangladesh, that's kind of impacting them, along with the US, which is still struggling. They're still trying to get back to growth there. But the big thing was obviously the litigation in Canada. They ended up having to pay around 6.3 billion pounds straight off the bat. So that's where this other operating expenses of 13 billion came from. So they had to pay that up front. But not only that, the Imperial Tobacco brand in Canada, and I think there's 3 brands together. They have to pay a total of 32 billion back over the next few years. Okay. So this 6 billion was obviously paid up front. The rest of it is going to come from their net income after tax over however many amount of years it takes to make that money. So it depends on how much they earn. Now, it does exclude non-combustibles. So their new categories will be untouched. So it'll be net income after tax based on their combustible sales in Canada. It is still kind of a huge chunk of money. But look, the impairment happened this year. It's already accounted for with this 6 billion. They still generate lots and lots of free cash flow. They are expecting to generate 8 billion a year, roughly. Their dividends are around 5 billion. I did a quick back of the napkin calculation. They are saying that they are going to earn 50 billion in free cash flow through to 2030. So if they raise their dividend by 2% every year, still gives them like a 67% payout ratio. So I think that's more than achievable. So
for the yield that you get in return.
Exactly. So I'm not overly worried about obviously the litigation there, but I'm not overly worried about one soft year as well. It just generates so much free cash flow, and if they return to growth like they say they have, I'm not worried. I also did also had a look at what they predicted in 2024. So at the end of 2023, what they did, and I did a little checkbox, and pretty much everything they said was tick, 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 tick. So it kind of gives me confidence in management that they know what they're doing. And look, they've already spelled it out for us. 2025 is going to be not the most, it's not going to be the best year for them. It's going to be quite a struggle, but I think it gives us a little bit more wiggle room to buy in if you want to. That dividend, I believe, is still safe. But yeah, that's the big news. I think it was soft forecasts, and litigation in Canada was the reason for the drop. Overall, I think earnings was solid.
Awesome. Yeah, you know my position, right?
Yeah, yeah. I do really like the company, but I think their ambition to go smokeless in 10 years, predominantly smokeless, Let's say that. So the
But what does
majority.
that mean, smokeless?
So I think it's all these new categories. It's like,
But there comes smoke out of vaping, right?
yeah, but they
If I
don't.
see the kids here, they're it's like it's even worse than the old cigarette smoke.
I think it's far worse, but I don't think they count that as smoking. I think that's where they come with
What
this.
is that then? Is that what a better tomorrow looks like? Is it like just the fog of Ireland, or what is it?
That is what it exactly what it looks like. They're not taking in nicotine; they're taking in some other crap that probably is not. It's probably not as good.
I mean, who are they trying to fool? Is it their own employees that they say like we're a tech annihilation company? Yeah, just to ignore the whole word smoke and have a smokeless tomorrow. I mean, what a bullshit. Come
But,
on.
but but like none of my close friends smoke. But you're in your workplace and stuff. You
Yeah,
have colleagues that smoke, and
yeah,
they genuinely believe that they're being healthier by moving from cigarettes to these vapes. That's what they generally believe.
yeah.
They're being healthier and it's helping them. I think it's too early to
To judge.
ascertain that, because if you go back 40, 50 years ago, there was adverts for smoking, retaining that was healthy. And nobody knew
Yeah.
what the consequences would be. So it's still too early, in my opinion.
It's like an alcoholic switching from vodka to wine and drinking more wine instead than
Yeah,
ever drink vodka.
exactly. But look, I still think it's an ambitious plan for them to say that they'll be predominantly a smokeless company at that time, considering the growth that we're seeing already.
I mean, it's just they're just fooling themselves, you know. It's like, I mean, whatever they say, they're selling addictive stuff, yeah, for a really good price, and that's the business they operate in.
Yes, while making the world a better tomorrow. Don't forget that.
Well, yeah. But you know, it's if you think about a positive, let's do this exercise. What is all positive about smoking?
What is the positive about smoking?
Yeah,
No.
I think it's a stress reliever. Many people during work, when they're stressed, they take a cigarette and they calm down. It's nice for socializing. I think for many people when they go out, nice smoking something together. I think these are the kind of the positives.
Yeah, I can see the
I mean, is it nice?
socializing.
Yeah, is it nice to go to the pub together, stand outside, and eat lollipops together?
No.
No. So
Yeah. No, I understand. I can understand the socializing bit. Having it as a stress reliever for me, it's just, I don't know. It's like drinking booze because you want to relieve stress. It's the same thing.
yeah, of course, but it helps at that moment in time. Yeah,
Yeah.
I mean, I'm not trying to advocate for smoking here. Actually, the opposite. It's a stuff that I never have done, never will do, and I try to keep my kids as far away from it. Almost nobody around me smokes, and I'm very happy with that, and I want to keep it that way. But you know, we go quickly into the sin category discussion again, and I always feel like for many stocks there are some positives. Otherwise, because these companies create value, there's a value proposition. Otherwise, people wouldn't buy their products. It's really as simple like that.
Yeah. They generate a lot of free cash flow too. That's
Yes, exactly.
that's my positive.
I think we became truly capitalists. That's what I can tell you here.
Yes, we have. We'll move on. And I'll do a quick take on maybe Agree Realty. I know you may have looked at their earnings as well, but it's pretty much in line what I expected. We know that real estate investment trusts are in kind of a challenging. They're kind of in a middle road, aren't they? Like,
Yeah.
a couple of years ago, it was really high interest rates. Now we don't know if they're going up, down, and it's just kind of flip flopping in no man's land. But they are continuing to invest quite heavily, and they invested approximately 1 billion in 282 retail net lease properties. Their net income rose 4.8%. Their core FFO increased 3.7%, and their adjusted funds from operation increased 4.6%. So with that, their dividends have only increased 2.8%, and you would kind of expect that with the amount of growth they have. You're not expecting that to go too crazy. They have upgraded. I think this is quite important for them. They've upgraded their credit rating by S&P Global. It's now BBB plus, which helps them when they are looking for more capital to buy
Yes.
more properties, and they have plenty of liquidity. So I think it was a steady year for them. And remember, they have no debt maturities until 2028. So still got 3 years of no real debt
And
coming
that
off.
was a brilliant move, right?
I
To
I
yeah,
I, I think so. And I went through the presentation. I didn't take many screenshots, but they actually did some quite nice things and went back over what Joey was saying 3 or 4 years ago.
yeah,
Things about e-commerce and omni-channel, how that's going to play out, and things around Walgreens, things around Tractor Supply Company, which is now
yeah.
their second biggest tenant. And he's nearly been spot on every time. It's like he's psychic with some of this stuff.
I
He's
think
just
he's good.
really, really
Yeah.
knowledgeable.
I think he really has a good hand in picking stocks. Like I think he observes which companies are in the uptrend, which companies are in the downtrend trend. He can see that probably right from the food traffic and everything, and he adjusts his portfolio towards that. He really follows the winners.
Yeah. And it was also quite interesting that when he was asked on the call around some of their clients obviously struggling. So I think Big Lots is one of them that's
Yeah,
filing for bankruptcy, and they've been phasing them out. But they're expecting maybe some other of the investment grade companies say
yeah,
to struggle a little bit this year. He made an interesting comment saying that there are other companies that are not investment grade, such as Aldi,
yeah,
who are quite strong and are in a good position, and he's not afraid to focus in that area if it needs to be. So I think he's very, very clued in. I
yeah,
do really like him as a CEO, I have to say. And
yeah.
yeah, look, I
He's
think,
very grounded. He's very grounded, and also what on the Dapper Dividends with Russ podcast, right, where he said
mm,
like the dividend is not going to be cut under my watch.
sacrosanct.
Yeah,
What he said. So yes, look, I'm quite happy. The growth was low, dividend hike is low, but I think with the challenging environment, it looks really, really steady. Um, at the current prices, I'd find it hard to buy them. I have to say.
yeah, very expensive.
I think the valuation is stretched a little bit, which makes me want to look a little bit more at Realty Income. I have to say, because they're trading at much better prices. But yeah, agree, Realty steady, um, nice overall.
Nice, nice, nice. Yeah, I love this company really. I mean, it's one of those where you just wish you bought more when it was trading around $50 last year, right? That's how I think about this company. You know, it is like you love it, but you hate it at the same time because you know, like "Oh, I wish I had more."
I don't because they are my number two position.
Yeah, well, they are probably towards my number 10, but I bought a lot.
Yeah,
Still not enough.
yeah. Look, and your portfolio is bigger than mine, so
Yeah, and I have the same with Defama. Yeah, the German one. I
yeah,
bought shares at 22 euros at the time. They're now 28. The CEO there as well. He continues to deliver, and similar to Agree Realty, I think. Very grounded CEO.
yeah.
Typically, you bought under promise, over deliver, and I also wish I bought much more there. Anyway, hey, let me take over the baton from you because everyone knows I'm kind of Mr. Ahold, right, on
Yes.
social media here. And it's a large position in my portfolio, somewhere around number 6 or 7, sometimes number 5. You know how it goes with share prices. Also, the share price here has been running up a lot. I think was it last year 28 euros, so 26, and now 34, something like that.
Yeah, I've seen you post that on Twitter when someone said this stock has gone nowhere in a year. You just post this chart and it's like an arrow nearly straight up.
Yeah, exactly.
It's quite
Yeah,
funny.
it's Solomon. He's a nice lad.
Yes,
I,
yes.
I think he compares it more with the Palantirs of this world. And yeah, come on. You know, this is a slow compounder. But look, what can I say about Ahold? Yeah, it's really simple for people that don't know Ahold that well. It's a grocery chain, supermarket chain. Let's say 45% of sales coming from Europe, the rest from the United States. Food Lion is for instance one of their biggest brands in the United States. So for people that are from America and listening, that's kind of where you can look into it. In the Netherlands, of course, Ahold Delhaize, Delhaize, Belgium, and then it recently bought something, I believe, in Romania. Uh,
Probably.
But what is also important here to know is that they still have the Dutch Amazon in their position,
Yes.
Bol.com.
Yes.
So when you then think about this company, I don't see anything in its multiple that suggests that they have a Dutch Amazon in them. Yeah. So that's the interesting part for me. It's like McDonald's in real estate. Yeah.
Yeah.
This one also still has a really strong asset there. But what can you say about such a company? It's so predictable. Again, it had like diluted EPS of €1.90, underlying EPS as they call it. So after some adjustment, €2. 50, I told you it's trading 34 euros. So whatever number you take, it's far below the 20 PE. It is
Yeah.
a 2.5 billion free cash flow. It's very, very doing well on the free cash flow. So 2.5 billion, but it pays like 1 billion in dividends and a 1 billion in share back. Exactly 1 billion, like 1 billion. Like it's very interesting. I mean, how they do that there. But so they bought back 2 billion in shares. They had like, let's say 500 million left, what they could do something with. So, I mean, and that's what it's doing every year. The only thing is when the price runs up, they can just buy back less shares. So because what you see is the dividends, then they are they are growing, and if they are able to buy back like 3% per year, then most of the dividends are already funded by the buyback. So that becomes a little bit more difficult at these elevated prices. You know, with such a free cash flow, they decided to grow the dividend again by 6.4%, as you said earlier. It's a good hike. I expected more around 4 or 5%, to be honest. So I'm very happy with this 6%. Outlook for 2025, exactly the same as what it always is, mid to high single digit growth. 2.2 billion in free cash flow. Another under promise over deliver company that we're talking about here. 1 billion in buyback. I mean, they can just copy paste every year the same. Yeah, and that's the beauty for me. I mean, I think when they selected the when they put a headhunter on finding the CEO, they said like, find me the most boring guy that is very smart and knows how to run a company. But please don't let this person have any ambition or aspiration to leave their mark into a company or something like that. We don't want people that want to have a statue with ego. Just find the most boring person you can find. I think they found it, because you need to be so boring to just want to buy back 1 billion in shares each year, pay 1 billion in dividends, and that's effectively kind of it.
Yeah. They hit the jackpot then. They've hit the jackpot. But what I think is interesting is the acquisition in Romania, Profi.
Mhm.
I think it's going to add around 3 billion in revenue next year. So we haven't seen the
Yeah.
impact of that yet. But it's an interesting avenue how they're going to expand in that area.
Yeah, but with an underlying margin of 4%, it will be 120 million maybe. Is that what we're talking about?
Yeah, pretty much.
Yeah. So under 20, well, it gives a little bit of cash flow again, right?
Yeah.
Yeah.
So I think this 2.2 billion. It's they were 2.6 this year, I think, were they? So they always, as you say, they always go lowball it. And
Yeah. So, Ahold, you don't buy it for the quick growth. You buy it for a good entry yield, I would say, and then the stability and the intention to grow the dividend each year. I think that's what you buy it for. It puts an anchor in your portfolio, but don't expect fireworks. Don't expect double-digit growth. Double-digit growth. There really needs to happen something specific there, but 5 to 8% each year is possible with this company. If you then get it at a more towards the 4% entry yield, you've got a nice deal there.
getting a little bit expensive for me, but I have quite enough.
Yeah. And people were asking, what happened? The share price dropped. I mean, I really don't have a clue what happened. I don't know what analysts have in their models. Yeah, but I think the price went a little bit ahead of itself over time. Yeah, and this is probably a bit more of a correction, but I have no clue why. I think the company is kind of priced for perfection at the moment.
When you see a price drop and earnings especially end of year earnings, is quite strong. It's normally a good mix. It's a good time that you could.
Yeah, but then you look at the numbers and you think like, okay, what am I reading? What am I not seeing? What others are seeing? Yeah, but it must be something like they probably, I don't know, maybe after the quarter three results, they updated their models, made it a little bit more bullish, and now they need to re-update their models again. I mean, that's the issue. Is if you're an analyst and you only model your forecast on 3 or 4 or 6 months, let's say, we don't do that. Yeah, we just look out for the next 5 years or something like that. Kind of take a few assumptions, and with that, you have more stability, I think, in it. And this is also the difference between dividend growth investing and maybe total return investing, because I don't know even how that investing is called, but like you're just all the time changing your target, then it drives you nuts. And the main thing it does and who benefits from it are the banks, because you're spending a lot spending a lot on transaction fees and commissions.
I feel like a little hamster on a wheel, just constantly chasing something but never getting there. Just adjust.
Yeah, exactly. Yeah, it doesn't fit my investment style at all.
Okay, we have two more that we might do some quick takes on, and I'm going to talk about Siemens. And Ed Kuba had asked about Siemens as well, and they had usually the first quarter is normally good for Siemens, but they had a really, really strong quarter compared to most years. And if you look at the first or second paragraph in the CEO comments, straight away it tells you that they have generated free cash flow of 1.7 billion, which is up quite a lot from 1.3 billion in this time last year. The revenue grew 3%, 18.4 billion, except for mobility, and I think that's coming from a higher base. So there was a little bit of a decline there, but it's based off more sales were off the scale this time last year, so it's hard to compare that. The profit industrial business has been quite strong. That generated 2.5 billion. Their net income climbed 52 billion. But what you have to remember is that they had a sale of Innomotics, I think it was, which was 2.1 billion. So that kind of beefed up that. Actually, I think if you were to look at EPS without that, it would have been down year over year. So
yeah,
wouldn't get too excited about that 52%. Also, earnings per share, as we can see, is up to 471. Again, most of this comes from that sale. But the big thing was free cash flow was up, and they are seeing revenue went up, but orders are starting to slow down, particularly in automation. Digital automation has been quite slow. And that's what they are predicting. So even after a strong quarter, they are still predicting a kind of a slow year this year. I think, look, they started quite well, generating a lot of free cash flow, and reduced their net debt to EBITDA down to 0.4. That was at 1.1, maybe 3 or 4 quarters ago. So they've reduced a lot of debt there. But overall, I think it was a strong quarter, but it's going to be, I don't think we're going to see that every quarter. And I think the sale of Inomatics kind of beefed them up a little bit, I would say. So I would not expect this next quarter. I would expect a little bit more the same. And with orders dropping back, I think we might see it level out over. But look, it is what it is. It's a strong company. It's in many, many different areas. When one falls down like digital automation, we have others like mobility that are propping it up. So I think that's the beauty of having this so diversified. So yeah, I think it pretty strong quarter, but I expect it to even out over physical.
Awesome. I mean, another company like clockwork.
Yeah, I mean, but they got their hands in so many pies. I mean, it's crazy, isn't it?
Yeah,
it's crazy, but yeah, but I think they're always a good gauge, and particularly because they're in Germany, and we know Germany is struggling at the moment. And actually, I didn't mention it there, but the CEO mentioned in the webcast that they are prepared for any tariffs that may come, and that they're well positioned because they've got lots of homegrown industries within Germany. So maybe there's stuff on the cards there. So Germany's in a lot of turmoil, and Siemens is like the head of Germany in terms of of business and a company. So it has to navigate a tricky macroeconomic environment at the moment. But as you said, I think it's a fantastically,
Yeah.
really well run company.
Awesome. Awesome. Well, then let's talk about another company then before we go to listeners' questions that I quickly want to touch on, and that's Unilever. And should we start calling Unilever the comeback kit?
Oh, that is the $1 million question. I mean, we spoke about 2 dividend hikes in a year. I was blown away by that.
Yeah. Yeah. Well, they're definitely back to the Dividend Growers Club. And
Yeah.
that was a big surprise for us because, we had this thing that we noticed that the new CEO suddenly took out the commitment of a growing dividend from their dividend policy. It was now an attractive and sustainable dividend, whatever that means. Yeah, that's just fake now. In any case, look, underlying sales growth grew by 4.2%, 2.9% by volume growth. Now, this underlying sales growth is a little bit of a tricky thing because these are not GAAP measures. This is effectively like what the company wants to focus on. Yeah, and with their portfolio changes that they are making, so of course they look at those a little bit more favorably. I don't think we would see underlying sales growth quickly be a lower number than the turnover based on GAAP. Yeah, so there's a little bit of IBM-ish going on here. But if you look at the GAAP numbers, it was a growth of 1.9%. Beauty and well-being just continues to do really, really well. And even the ice cream business had an excellent year, I would say, which is also interesting because they are, of course, I think IPOing it. I think that's their ID. And oh boy, of course, with Ben and Jerry's this week, they were in the news again that they asked I think the VP of Eisen and Unilever, at least that was in the media, is asking Ben and Jerry's to not say anything about Trump, not anything bad. And of course, this company doesn't like it, Ben and Jerry's, because they have this so-called full freedom in whatever they want to do. And they have a social activist culture there. Anyway, definitely beauty and well-being and ice cream being really the bright spots last year in the portfolio. If you look at their non-GAAP numbers, they say that they had an underlying operating profit growth of 12.6%. If you look at the GAAP numbers, and I'm saying it on purpose, you see a decline in 3.7%. I really want to be clear on that. Also, the earnings per share diluted GAAP 2.29, a 10% decline compared to the year before. And the underlying earnings per share 2.98 euro and 14.7% growth. I prefer to look a little bit more at the GAAP earnings if I see too big of a gap here, because there may be a little bit too much optimism here from management. So in that case, I understand why the share price also went a little bit down. I don't think it's necessarily with that, probably with the outlook more and the margins, because the margins were a little bit less, I believe, in the second half compared to the first half. And that's what investors and analysts really look at. What is interesting is to see those power brands, which account for more than 75% of turnover, were really growing the business by 5.3%. Volumes accounted for 3.8%. So in my opinion, this company is just doing really well. The underlying operating margin grew to 18.4%, which is much better margins than we ever seen under Alan Yopi. And this, again, what I want to say, I was listening to the earnings call where the CEO, Heinz Schumacher, opened, then the CFO, and then also the questions. And I mean, what a difference a CEO means. Alan Yopi was always like, and he wanted to screw us as shareholders with the GSK acquisition for 60 billion. Remember that? If they would have bought it, that could have been the kind of debt that Monsanto did to Bayer.
Yeah, nail in the coffin, kind of.
Yeah. So happy that there was so much shareholder resistance that he didn't do it. Yeah, so happy. But this CEO, oh my God, every sentence, there comes so much energy and conviction out of it. And how he talks about the productivity, and up another 3,000 people gone. I think in 2025 they will let again, and just seeing that there's too much fat on the bone in this company and making it much leaner. And I mean, he's sharp. He's really sharp on what he's doing.
Yeah, and I mean, when I look at these numbers, they don't blow me away. I mean, right off the bat, you're right.
No,
Underlying
yeah,
performance, which is their own, looks reasonably well. But we've seen these kind of numbers under Alan Yopi. In fairness, we've seen low sales growth of 1.9%. We've seen small amount of volume growth, even though they say it's 3.8% for the power brands. So the CEO must be making a difference in how he's delivering it, making
yeah,
it seem like it is more optimistic than what it is. Because when I see these numbers, I'm not automatically going, they're a comeback hit. I'm seeing a slow turnaround. I
yeah,
am, but I'm not immediately blown away. But I really do like Heinz Schumacher, I have to say. I've said this
yeah,
to you before. As soon as I watched his coffee table chat,
mhm,
or first
yeah,
chat,
yeah,
he had me kind of hooked. Now I've sold out of that position because
yeah,
I've learned not to rely on CEOs too much, but
yeah.
he does have that charisma. He does have that kind of sense around him. So
Yeah, so and this is the thing. I mean, they have a plan in place. They want to focus on certain brands. That's why they report this underlying sales growth. This is really what they want to focus on, because and the other part, the gap still includes a lot of portfolio management decisions that have been done and that are ahead of them. Yeah, so I think that's why they're looking at. But in the end, I want to see gap numbers
yes,
increase. That's what I want to see. So the other part, the underlying numbers, they give maybe a bit more optimism. But next year, I want to see the gap numbers improve. It's as simple as that. Yeah, we may give them an out of jail card when it comes to the IPO, maybe of the ice cream business, because of course, if they spin it off, the sales will be less unless they kind of keep a lot of shares in it, and then they may need to account for it differently. But I mean, I want to see the gap numbers go up.
we should we should see operating margin go up, and we should
Yeah,
see even if sales go down because of the ice cream business. But let's see. Let's give him a yeah.
exactly.
I think he's doing really well. I'm just not.
He still deserves the benefit of the doubt
Yeah,
at this moment in time. Yeah.
I think so, but I'm still unclear about this strategy around power brands. I still think it was too vague for me, even though they say what did.
Yeah, but what is good to see now, Derek, is that a lot of the sales that they are growing is coming from volume, not from price. That means generally that they are selling more, which is a
Yes.
really good sign, because the years before it was mostly price, 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 price. Yeah,
Yeah.
and you can, I mean, how much can you milk a cow? Yeah,
Until the cow is dry, and then you can't
yeah,
anymore.
yeah. And for instance, the Magnum, you really can't make the Magnum smaller anymore, because then it's not a Magnum anymore.
Mini magnums.
Mini Magnums,
Just
yeah, for the
boom.
same price as the big Magnum
Yeah.
used to be. Yeah,
Yeah, nice one. Look, well, we know in the early days of this podcast we were Unilever and Danone. We haven't spoke
yeah.
about Danone in a long time, actually.
Oh, that's
But
true.
it's nice to
Danone is
see.
also having a revival, right?
Yeah, yeah. I think they reported a little bit later, so we might
Yeah,
look at them. But it's nice to see these showing signs of turnaround, even though they weren't a full turnaround company like say Intel or something. They
yeah,
were in a little bit of a rut, so it's nice to
yeah,
see them grow.
yeah.
Listeners' questions, and we'll start with an email from Fabian, and quite a nice question. This, right? So think about this: Company A has a 5% operating margin. This margin is fairly constant over time, with a standard deviation of 1 percentage point year. Yeah. Company B has a 20% operating margin. This fluctuates considerably from year to year. Assuming both companies trade at the exact same valuation, what one would you want to own?
I will go for the 20% operating margin.
Why?
Why? I just like companies with higher margins. When a company has a higher margin, it usually suggests that they are having a product with pricing power.
Yeah, 5% operating margin does not give you much room for error. So if
Mhm.
they have a bad year, all their profits are gone, gobbled up, gone.
Yeah, and it shows that there's a lot of competition. Otherwise, they would have been able to increase the price much more and
Yeah.
therefore have a higher operating margin.
And effectively for the same price, you would expect company B to compound faster over time.
Yeah.
And grow a little bit faster. And if you're getting them at the same price now, technically, I would consider company B undervalued compared to company
Yeah.
A.
No, but look at Visa. It's known for a really high operating margin. Why? They kind of almost have well, not a monopoly, but I mean, trying to get to the state what Visa has been doing. Let's say very high entry barriers to the market.
Yeah.
Yeah. Now, when you look at Ahold, it has an operating margin of what? Four? Is it operating? I don't know if it's operating or the profit margin. 4%. Yeah. It's because like anyone can start a grocery chain.
Yeah. But what about if utility? Like, would probably be you probably settle for 5%
Yeah,
operating margin because of
yeah,
that predictability, defensive. You know what you're getting. Like, you
but
don't really want that
utilities.
volatility.
Yeah, but utilities are regulated.
Yeah.
Yeah, so it's for me a different story again. Yeah, but I'll go for 20% for those reasons that I mentioned.
Yeah, me too. Robert Doyle is thinking about opening a position in Johnson and Johnson, and he's asked us, would it be better to buy it on the New York Stock Exchange or on IBIS? And he's thinking about currency and tax implications. Honestly, I don't think we can answer that. I don't know which one would be better for currency or tax.
Yeah.
would,
But what is good to know, right? Sometimes people think that, for instance, if you buy it in on the German stock exchange, that you have different dividend tax or something.
no,
like
no, no,
no,
no,
no, exactly.
But I've talked to a tax advisor if you're really stuck. But
Yeah,
I always prefer, excluding British American tobacco, which I bought long ago.
yeah.
I always prefer to buy them on the local stock exchange.
But this, for instance, if you buy Johnson Johnson on the German stock exchange, let's say, this is still then fall under the estates tax rules, I believe so, right? It's an American business.
I can't be 100% sure, but I
Yeah.
would imagine so.
Yeah,
Imagine so.
exactly. I don't think they would allow such a loophole, right?
Interesting if they did.
Yeah, exactly.
My answer would change, Robert.
Oops.
My answer would change.
Light bulb going off there. I see that in your eyes.
Yeah, I never thought of that. Tim has asked, do we have a plus or minus position percentage tolerance that you allow for? So maybe this is more aimed at you because you have this tiered positions.
Yeah.
So if you have a 4% position, can this be 3%, 5%?
Yes, of course. First of all, I think that my percentage tiers are more on the money spent to some extent. Because some companies like Upfee, they more than doubled. He outpaced others. I'm not going to sell and trim Upfee and punish them for it. Yeah. So, yeah, it can be. It's for me more directionally.
Yeah.
Not like something I will be very tough on.
I think something as small as 1% is fine. If you start going plus or minus 3%, 4%, then you might as well throw that position out the window.
Yeah, exactly. And that's how I look at it as well. But I mostly look at it also from a cash invested point of view. I try to look at it, but usually it all different. That's the nice thing. It all kind of falls with puzzle pieces together. So it's not like I need to do a lot for it to get it in that. It's kind of that the portfolio balances itself out a lot. That's what I noticed. And I can't even tell you why. Probably it's just because I'm buying boring companies.
Andreas, it's Valentine's Day. So love your stocks day, which I quite like. But here's two questions. What is your most loved stock in your portfolio right now?
So if I wanted to go on a date with a CEO.
Oh, I like this.
It has to be such an Adela. It has to be such an Adela.
Microsoft,
definitely.
I could have predicted that. Based on today, and I've learned that Brookfield, like the 15% dividend, I would probably pick Brookfield, but two companies, Shell and Vici, are probably two that I really like the most. Vici is not going anywhere in terms of share price since I've been beating on that drum, but I still love both of those stocks. So look, it's polygamy. I'm picking two. I'm picking two, not one. So we're polygamist, but Vici and Shell. But the second part of this question is, what is the first love? Maybe it got away. Maybe it is still in the portfolio.
What was the first love? So, it has to be Microsoft again. I bought them at the time with quite some conviction, and yeah, it has to still be Microsoft. I mean, Ahold definitely my second love. Yeah, but Microsoft first, I think.
Glanbia was my first because it was the second dividend stock I ever bought, but the first one that paid me.
Yeah.
I won't forget that. So yeah, Glanbia, but I sold it way too soon. So I sold it because I didn't do a deep dive. Remember, I had this huge portfolio,
Yeah.
60 stocks, and I was trimming down. And then later, maybe last year, I did it for the newsletter. I did a deep dive on Glanbia, and I'm like, what an idiot I am. I should have just kept them and not trimmed down my portfolio. But yeah, they were my first love. Dividend controller. What's the one principle that you got from your parents that you try and teach your own kids?
So it's maybe not investment related, but in Dutch you say, my mother always told me, kijken is ook lekker. It means watching at it is also tasty. It effectively means like as a kid, you're every time can I have this? Can I have that? Can I have that? And my mother always answered like when it was around candies, like watching at it is also tasty. And because my kids also, they just want everything all the time and so much consumerism. And I try to teach them a little bit like, guys, work with a budget, have a few zloty, you can buy something with it. Don't spend it the first minute you're outside. Think about it, plan a little bit ahead. Of course, I'm doing something that their brains are totally not geared toward. Also, the algorithms on YouTube and everything that make it only more like dopamine kicks all the time. So they want to spend it straight away, but at least it's something that I'm trying to teach them.
Yeah, one that I like is we say you only get out of it what you put into it. I really like that. And it's just trying to teach them that if you put in the work, you put in the hard work,
yeah,
you will get your benefit. It might not be right now. It might not be when you want it. If you keep putting in the work, keep doing it, you will get your rewards out of that. And actually, when I went back to college, that was our class motto. We just kept saying it, and we were studying, and just to try and keep us going. You only get out of it what you put in. So if
and look at you now on a Friday night, you're doing podcasts for God's sake.
Yes, exactly, and we love it.
That's true. That's true. Yeah.
Carlos has asked us about Bats and John Deere's earnings. So I spoke about Bats. I actually didn't get to look at John Deere's earnings. I don't know if you did.
No.
Sorry, Carlos, I didn't see this question until literally just now. Mayak has asked us about Google. And we spoke about this with Dividendology last week, but do you think Google today is like Apple in 2017?
No. Google is trading at the 22 PE at the moment, I believe.
Yeah.
I'm not 100% sure because I don't have the data in front of me. So if people say something, correct me, then that's why. I also remember that the 2024 earnings were much higher than the 2023 earnings. Yeah, and the question is it a one-off big bump or is this a new trend? But let's say 22 earnings. In 2017, I believe, when I was buying Apple, or 2016, it was trading at 11 P or 13 P. So it's still half of the price of almost of where Google is trading today. So if Google would be at 1995, I would say yes. But Apple was trading at that time, guys, around 11 or 13. Now it's more between 30 and 40. There's been so much multiple expansion since then, and everyone thought the iPhone was dead at the time.
Yeah, was nobody saying that around Google at the moment. But who knows with AI and more, because I kind of like Perplexity, for example, as a search engine.
It's a nice one, right? Perplexity.
Yeah, I really like it. But with these kind of innovations, maybe we might see it teasing out, but I mean, they still got the cloud growth. They still got so much.
Yeah. I think their business model is under threat, the search. Yeah, and with that, the ad revenue is under threat, but they're still full in the game.
Yeah, and I don't know how you'd replace YouTube. maybe there's a way, but YouTube as a search engine is probably higher than
Yeah, well, but I
Google.
think TikTok took a lot of eyeballs away from YouTube.
Yeah, but you look at TikTok for short content, like, but if you want to learn something like how do I do this,
Yeah, yeah,
usually,
yeah.
usually you go to Facebook. I'm not going to go on TikTok and ask him
To
how,
YouTube, you mean?
how am I going to hang up something on a wall. I'm not going to go to
Yeah,
TikTok. Whereas
but
YouTube,
we are a different generation.
Daniel and Morpheus have both asked us about T Rowe price. It's now low dividend growth, has continuous outflows. Are you still holding?
Yeah, I'm still holding because the earnings are growing while there are outflows. That is because the assets under management are growing, which is a sign of the stock market is rising. So the stock market is rising faster than more than the outflows of the company. So for now, I'm good. No debt on the balance sheet, I believe. So I'm good. With such a stock, I would rather wait for a dividend cut.
Yeah, for me, they're set and forget. I
Yeah,
don't
yeah,
even.
yeah, yeah. Exactly.
I
The
don't look.
dividend is safe. They are struggling a little bit with you know, they need to modernize a little bit the way they provide services to companies and such. But with this balance sheet, it's really kind of a sleep well at night stock.
Yeah, yeah,
And it's a small position. It doesn't need to be big. Yeah.
yeah. When they return to growth or when they start doing really well, they do genuinely
High quell. Yeah.
really reward their shareholders. So yeah, for me, it's set and forget. I know there's outflows, but until I hear something really drastic, I'm
Exactly.
just ignoring them. I know it's low growth, but I have a decent yield with them as well.
Exactly.
Not too bothered at the moment. Let's say.
Same here. Same here. Maybe
Um,
we're just boiling frogs. Who knows?
yes, who knows? And look, people that talk about opportunity cost and so on and so forth, but sometimes you just need boring companies to anchor your portfolio and
Yeah,
just to
but
leave.
we invest for the income. Yeah.
Has asked us our opinion on oil service stocks, non-traditional dividend growth, but have some very high yield opportunities. And he's mentioned a company, SBX, on the Norwegian Stock Exchange. Do you reckon there can be sustained dividends in oil adjacent service providers?
So I have not looked into this stock, but generally I'm a dividend growth investor. So I think this is more coming towards income factory stocks. Yeah. Here.
Yep.
But the question is really good. Do you reckon there can be sustained dividend in oil adjacent service providers? No, that's not what I think. If you look at the value chain or the supply, let's say the value chain, companies like Shell, Equinor, they own the assets, they own everything. And how I said, that means also the cash flows and everything are coming to them. So if they decide to cut capex spending because there is an oil downturn or something like that, those service providers will be very quickly in shit. Now I don't know this company, but that's where the powers in the value chain is with the asset owners, like the big oil companies, and everything in that industry is therefore in service to them. Now there are also companies like Siemens that provide equipment to this industry, but they are diversified enough to also cover other sectors. But pure play oil service providers, I think it's hard for them to do sustainable dividends, specifically if they focus on high dividends there as, let's say, 80% of cash flow or something like that, because those cash flows will be hit the moment there comes an oil crisis or something like that. Again, I don't know this company, but if you ask me generally how I look at those companies, then those are my thoughts.
Yeah. David has asked us about Domino's Pizza. So we all know Warren Buffett bought them a while ago. Has this company ever been on your radar, considering the yield is 1.28?
I mean, they have definitely been on my radar, but as a European, I don't understand why you don't go to Mario, the local Italian guy that makes a pizza for you. Why would you go to Domino's?
I would agree with you. So you've been in my house, you know where I live,
Yeah.
but when you were here, it wasn't set up. But Domino's is literally 30-second walk from my house, right?
Yeah.
Literally just right across the road. Actually, where we went for coffee
Okay. Yeah.
just beside that, they've put a
Yeah.
Domino's. Okay. But there's also across the road from that, they have this little Mario's. It's called Napoli, and it's right beside it. And I would much prefer to go to that one than Domino's all day long. It's much
Exactly.
nicer, authentic Italian.
Exactly.
Italians working in there. It's perfect. I'd much
Yeah.
rather support that kind of a business. But
Exactly. Me too. So, and that's why I can't easily own anything Domino's. I don't live in America enough, therefore, to understand this whole thing about Domino's.
But I mean, they've been talking about AI with Domino's, Microsoft partnering with them. There's a whole lot of stuff.
What AI in a pizza? What are they going to find me the optimal pizza? Like how much pepperoni I like based on my profile? Is that what they're going to do?
I don't know what they do, but I would imagine you will see robots working in there. Do you ever see them? They have some in America actually making drinks, and you have to,
Yeah, and they had this little robot going over the street and everything. So clearly they're very innovative. But do you think that pizza should be manufactured? I mean, it takes the love out of the process. Maybe I'm too old style for this, but this little Mario that is like nicely making this ball of dough and putting it on the finger and twisting it around a little bit, putting with love some oil olive oil over it. Oh my god, some oregano. How is it called? Oregano. These herbs. Some the best of this cheese. Come on. Can a machine ever replace that love in the pizza?
not in a million years. No way.
No, exactly.
I'm with you on this. Last question goes to Jarson or Jason. But love to hear you speculate about Novo's future profit growth and how it could be affected by the US tax from Trump administration.
Yeah, so what I understand here is that they may want to put a tariff on those products, and suddenly the people in America will pay more for their weight loss drugs. Yeah, that's what it comes down to. It's a very interesting question because I've been pondering a lot about this. Like, how long can they continue to grow with this? I mean, the market is huge for Novo Nordisk, right? And I did a deep dive on it as well. It's really huge. There's a lot of potential in the upcoming 5-6 years, but all comes down to if they are able to lead the way in, for instance, turning this into a pill. Yeah. So making it easier to use these drugs, I think that's what's key there. They have the right brand, so they're mostly known for their brand, so they've got a first movers advantage. But now it's all to the next steps and the execution of the upcoming patents. I mean, this pharma, this is in general, but in this case, there's so much competition. Yeah, and maybe it needs to be priced in a little bit more.
I don't like the thought of a weight loss pill. Pop a pill to lose weight. I don't like it.
Well, you prefer a needle in your arm.
Nah, I prefer to just run, swim, cycle.
Yeah. Okay.
No, but I just struggle. I know there's a market out there, but some of the people using this probably don't need to use it. Which
but I know someone who is like born already thick.
Yeah,
and this for this person, it's a miracle drug. It's a miracle drug, and is so thankful that it exists.
There is some medical cases out there, but is it as much as how many consumers are taking this? Probably not.
Yeah, but yeah. So okay, I mean, I hope to never need it, but come on, it's the same as tobacco. In the end, you care about the cash flow.
Yeah, true.
and we need people that don't have a good discipline. Otherwise, I mean, half of the portfolio dividends that I have will be wiped out. If people live well and longer, then let's say the Nationale Nederlanden with their life insurance would not be so profitable.
Yeah, look at you calling me a hypocrite with my tobacco stocks, beer stocks, gambling stocks. Yeah, and I don't want the weight loss drug in my portfolio.
Yeah. Well, hey, look, that's why this is pep talk. Yeah, that's why this is pep talk.
Nice. And he also asked about some small cases like a Swedish company,
I don't know
maybe.
them. Yeah.
But yeah, no, I don't know.
Yeah.
Nice. That was the last question. I thought that was an entertaining earnings. There was lots to go through. John Deere is probably one on my list that I haven't got to, so I'll try and get to that one. But I think British American Tobacco is the one people are most interested in, particularly with their share price dropping. All good note.
Awesome. Awesome. Well, hey, thanks again for this awesome podcast episode. Looking forward for next week again.
Yes. And to all our listeners, see you next week.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.